presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for September 13th, 2022. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for tuning in. Today was an ugly day in the market, and I'm going to talk about a lot more about that. I'll talk about the Fed this week, what they're expected to say and do, especially next week. The expectation is they're going to raise interest rates by 75 basis points. It was between 75 and 50. Now the expectation is between 75 and 100 basis points. That means a full percentage. Why has that changed? We'll talk about that. The market, where do we stand after today's decline? The worst day in the market since June of 2020. That's what we saw. Where are we headed next? Are we headed for new lows? I'll try and answer that question in just a bit when we take a look at the charts. The U.S. economy, we'll take a look at that. We'll take a look at the weekly technical indicators. The market meter, what does that look like? What is the recession chances? Have they gone up? And the outlook for the week ahead. So let's start with the Fed this week. The inflation number came out. It was hotter than expected. 8.3 was lower than the previous month. It was expected to be somewhere around 8.3 or even maybe slightly lower than that. Remember, we had a number of 9.1, then 8.5, now we're 8.3. So why did the market react so negatively? The core rate, if you take out food and energy, which was a big part, it was still up 0.6%. The expectation was that core would be up by 0.3 or 0.3%. So inflation was double at the core level. And that's what the Fed looks at. That's how the Fed makes decisions on how much to raise rates. The more they raise rates, the more they slow down the economy. More they slow down the economy, more chances that we could go into a recession. That's historically what happens when rates go up. People can't buy homes. Mortgages now are at 6.3%. They were nearly 3%. They've nearly doubled the mortgage rates. The prices of homes are up. And if you've attended some of my seminars over the last year or so, one of the things that I mentioned, I said energy prices are expected to come down. The one thing that was worrying me about inflation was shelter prices, and that is rents. Because we had seen real estate prices go up dramatically over the last couple of years, but rents had not gone up because we had the mortgage, the rent moratoriums, the eviction moratoriums, where landlords could not raise rents. We had all this government support for rent. That has fallen off, and now we're seeing rents going up, catching up with real estate prices. And that is a lag. It follows. It doesn't happen immediately, even though real estate prices now are weakening because mortgages have gone up. But that will not show up in rents for another 12 to 18 months. Same thing with the Fed raising rates. The Fed has already raised rates 75 basis points at the last two meetings, and they're expected to do that again next week, next Tuesday. But that will not show up in the slowdown in the economy until later on this year. So the market is reacting right now of inflation, and they're worried that the Fed will go too far. Historically, right now the probability is that they're going to raise rates by 92% probability. Now it's at 100% today now that they're going to raise it to 75 basis points to 3.25. Expectation is now that they're going to go another 50 basis points at the next meeting and 25 by the end of the year, and that'll put us somewhere around 4%. Or maybe 4.25, depending on how inflation numbers come out over the next, and that the market is adjusting to that. The expectation of the last couple of weeks had become, oh, the Fed is done raising rates. They're going to maybe start slowing down the rate increases. But after today's inflation number, all that hopeful talk, all that happy talk is out the window, just like in June, where we were saying, oh my God, the Fed is going to raise rates, kill the economy. We'd gone to one extreme. Now we've gone to the other extreme, and we had gone, and now we're coming back to reality. People who were trying to sell the lows, they sold unfortunately in June. They bought in August, at the beginning of August, because the market had gone up 17% from the June lows. Now they're selling again. Unfortunately, they're getting pushed out. because they don't have the right allocations. You want to have the right allocation, the right mix of assets in your portfolio so you can handle the volatility. If you don't have that, you are going to get pushed out, you are going to get emotional, and that's where the problem comes in. If you're a day trader, you make money, and then you get caught in one trade and then wipes out all your profits, and then you're just a hold and hoper, where you're holding and hoping one day you're going to break even. Unfortunately, all the crypto people, they're gone. So having the right allocation, having the right mix of assets, what gets you from where you are now to where you want to go, but not just the allocation, having the right tax plan, having the financial plan, having the retirement plan, and that's when you need a separate team of financial planners, not the people who are managing the money, but a separate financial planner that just does the what ifs, has a decade or 2 decades of experience just doing financial planning. And that's what every client at Compak has. They have the asset management team that manages the money. That's the investment committee. Then you have a financial planner that is totally separate, that's just doing the financial plans. And then you have a relationship manager that is keeping you updated what everybody is doing to get you from where you are now to where you want to go financially. Again, the Fed policy, they've raised rates already. Will they be able to bring in a soft landing? That means slow the economy just enough that inflation comes down, but not too much that causes a recession. Where if you look at it since 1950, when every rate hike, when they started raising rates until 2015, they've only been able to have a soft landing 1, 2, 3 times. All the other times, they've caused a recession. So probability is that we are going to head into a recession. How bad is it going to be? We don't know. That's the question. Is it going to be a mild recession? Is it going to be a very deep recession? I'm still on the thought that it's going to be a mild recession. As I've said, so far it's a recession for people who own stocks, people who own real estate. It has so far not been a recession for all of America. And the recession happens when we have unemployment going up. We are going to see the Fed continuing to push the brake pedal until unemployment starts to go up. When unemployment starts to go up, that's when everybody slows down in the economy. Looking at the market, bear sentiment is at the highest point. Remember in 2008 when we had the Lehman crash? This is the 1990s, 89, 90, when we had the last. You look at that, we are much more bearish now than we were when the Lehman market crashed. So I think the sentiment has gotten as bearish as we can. We need to just clear out some of the people who got overly bullish over the last couple of weeks. So again, as I'd mentioned in the last few weeks, we needed some backing and filling. We had gone up so much, kissed the 200-day moving average, and we're backing off from there now. We're in September, which is a bad month. I think we still are going to have the volatility. You're looking at the leading returns. Again, the one that has returned the most is the energy market. That has done the best. Looking at the economy, whenever the Fed contributes to real GDP growth, whenever they're doing fiscal stimulus, that has helped GDP growth. When they're pulling money out of the system, which they're starting to do now, that is, has a negative impact on it. Right now, people are still buying the things they need. You look at Kellogg's and soup and Coca-Cola and ketchup. You can see those things, year-to-date percentage change, those are people's needs. People wants, when they want to go and buy a new TV or Home Depot or Target, those are not doing wants. So needs are still there, and that's why you have to look at companies that have good cash flows, companies that can withstand the recession, that are going to be here 5 years from now. Companies that are not and are high growth, those are not going to do as well. You can see the households are still sitting on a lot of cash. If you look at the amount of cash that household leverage is way down right now. So it's one of the lowest levels we've seen in about 50 years. So even though we are going to slow down, I think the balance sheet is still good for corporations and individuals, so we can handle the slowdown, but we have to get there. We have not slowed down yet. Shelter inflation is still going up, and that was a big contributor to today's inflation numbers. That is expected to roll over somewhere by the beginning of next year. So it is going to continue to push inflation up, rent prices, but hopefully the other things like food, which was a big contributor also to today's inflation number, will start coming down. Energy prices are coming down, depending, we don't see something unforeseen in Ukraine. The Russians are starting to lose. What will Mr. Putin do? We don't know. And that is something we are starting to see. Some of the things that contributed, like used car prices to inflation, that has already rolled over. As we had predicted, if you had come to the seminars earlier on this year, we had expected used cars and new car prices to start going down in the middle of this year, and that is what has happened. Rents, unfortunately, will continue to push inflation up until the end of this year, but we think those are lagging indicators. We think inflation is going to start coming down. The Fed is going to start slowing down their interest rate increases, but not quite yet. We are going to continue to see this bumpy road in the markets. Don't forget to join me on a daily. You can go and download the app. Just go down to the Apple Store and type in this entire market wrap with Mo Ansari. If you type this entire word in together, market wrap with Mo Ansari, you'll get the free iPhone app. And you can get the daily edition of Market Wrap, a 1-hour update every day on what I'm thinking, what I'm doing, and great guests. Like today, we had Mark Hemrick, who is one of the people that asked the Fed, Mr. Powell, the questions at the press conference. Last press conference, he asked some of the questions. He'll be asking Mr. Powell again. He was on the broadcast today. What does he think the Fed is going to do? All of that in the daily edition of Market Wrap. Looking at the technicals, we're sitting right here on interest rates. This was 3.48. We closed at 3.42 today on the 10-year note. If we break above 3.5, which is right here where we are now, we break above 3.5, we could go all the way to 4%. That's our target on the upside, 4%. 4% 10-year note will definitely cause the market we have to rethink the market at that point. If that happens, we're looking at probably a retest of the 3,600 or maybe even lower for the S&P. Looking at the S&P, this is a 50-day moving average right around 4040. We gapped below that today. This was yesterday's close. This is today's open. You can see they do not overlap. That's what is called a gap on the charts. We gap down, closing today at 39.32. Support now is going to be last week's low, which is 38.86. 38.86 is the number that I'm looking at. That is this low right here. If we break that, there's a tiny gap here, right at about 3,800. And that's why I've marked out 3,800 as the next support. And that would also give us, this is wave 1, 2, 3, 4, and a fifth wave low. If we come in somewhere here in the next couple of weeks, that could be good. If we break below 3,800, get below here, then it's a test of this fifth wave low, which is 36.36. Break of 36.36, we could accelerate down. Looking at the weekly chart, each one of these lines in 1 week of trading, we went up to resistance. Again, about 4,300, failed from there. We had a key reversal where we went below last week's low, closed above last week's high, which was a good sign. Unfortunately, we might see another reversal to the downside, depending on where we end up. I mean, today was a very negative day, but I think people had been leaning towards a much better inflation number. When the inflation number came out much hotter than expected, all those people in the last couple of weeks who had gotten overly bullish had to liquidate. We'll have to wait and see if we can hold. Same thing happened to the NASDAQ. We went up close to the 200-day. This is a 200-day. Failed there, came all the way down here, went back up, fourth wave up, fifth wave down. We're starting that gap lower below the 50-day. Support now, again, this tiny gap right here, which is 11,250. This gap right here, which brings us to 11,250. If we break that, then probably a test to this low. But that would be unusual. When the market gets above my dot plot, this is my dot plot, and when the market is above, it turned up here in March of 2020. It stayed up for a year and a half. This is where the dots turned down again right here, where the market turned down and the dots went above the market. When the dots are above, that's a bearish sign. When the dots are below, that's a bullish sign. So a year and a half we were bullish, we turned bearish, stayed bearish until July of this year. That's when the dots again got below the market. But the market hit this high. Now we're still above it, but that's 11,150. If we hit that, the dot plot turns down, which would be unusual. That we turned up and then again we turned right back down again a few weeks later. So this is still, and this is a 200 week. Last time we came here, held it, turned back up from there. So we have to hold right where we are. We're 11.6 right now. 11.150 would turn me bearish again, and that would set us up for new lows in the market below here. And probably then we're looking at somewhere here, which is around 10,000 plus or minus. If we break below 11,150, we'll have to wait and see. Maybe today was the washout, that we got the big down day, washed out everybody who had gotten overly bullish, and then we start building a base here. We're still in September, as I've mentioned over the last few weeks. We'd back off in September after hitting the 200-day moving average. That's what we did. I think we are going to come back down, and that's where we are now. We make a low in September, and then we have the midterms, and after the midterms, the market usually has a good rally. So we will see if we can hold these lows right where we are now and start turning up from here. Crude oil came to the 20-day moving average today, turned back down. 81.20 is the low that we're holding. We closed at 87.56 today. 96 is resistance on that. Gold, it hit the 200-day moving average as 1834. We hit that right here, turned back down. Here's the 50-day. But with the interest rates going up, dollar is going to go up, and that puts downward pressure on gold. Critical support is this low right here, which is around 1678. A break below that would push us down towards 1600 for gold, and that is my eventual target for the gold market. That's the way I'm looking at these markets. Again, if you need help with your portfolios, give us a call, pound 250 on the cell phone, talk to Mo, pound 250 on the cell phone, talk to Mo. That's what you dial. A member of my team will be more than happy to help you develop a plan to create wealth over a period of time. How you need to get all of these things to get from point A to point B instead of chasing this shiny object or that, you have to have the long-term plan and be able to execute it. You can see my market meter recession probability has gone up. It was 45 last week, and now I'm looking at about 55% as the chances that we are going to have a recession. Is it going to be mild or deep? That's the question still has to be answered. November 2nd, I'm going to do another webinar. If you want to come and attend, go to compak.com and register right now. compak.com, and you can register right there for the webinar. It is absolutely free. Looking at the week ahead, a lot more volatility. Next Tuesday, we're going to hear from the Fed, probably 75 basis points. Well, what they say afterwards is going to be key. Do they think they've done enough? Do they think they're going to continue to raise interest rates until inflation behaves? So that's where the market will be focused next week. I think more volatility until we come in, make the low somewhere in September, beginning of October, and then everybody's focus will shift back to earnings and back to the midterm elections coming up in November. So that's where we are, more volatility for the next couple of weeks. Those are my views. Those are my thoughts as of September 13th. Again, thank you for tuning in. I will be back again next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.